We've noticed, particularly in the last few months, particularly on the retail side and the wholesale side, people are realising their bank bills and term deposits are coming off. They were getting sort of 5-4% or more sort of a year ago, and what's who are rolling off saying, look, I can't really survive on 3% or 3.5% or thereabouts. So people are now moving more towards equities, and we've seen a big pickup.
Essentially, there's the never-ending debate about where people should put their money, and when you invest in an asset class, the returns you're going to get really will be based upon the long-term cash flows you can generate from that investment. I know prices move in the short term, and that's called capital gain, but that's a sort of speculative part of the investment. But the capital gains really are derived from that cash flow. So therefore, you've got to look at, when you look at an equity investment, you look at the earnings yield. So the average earnings yield of the market at the moment is about 8%. Okay. If you look at your investment property and the cash flow you earn from that, i.e. all the rent, the earnings yield is about, on average, 3.5%. Some people might get 4%, some people might get 2%. And I'm being generous there because that's actually before maintenance costs and all the other little add-ons which can actually slice away that. So really, if I'm doing it apples by apples, it's probably close to 2.5%. But just to be generous, let's say it's 3.5% for property. In the bank, you're probably getting 4%, maybe 4.5% at the moment. The earnings yield of shares is 8%. The dividend yield is about 6%, but you don't look at that because that extra 2% is kept by the companies, and you still own that money, but it's used for reinvestment purposes, etc. So the numbers are too disparate to have any argument about which is the cheaper asset class at the moment.
We're still quite positive towards, I suppose, infrastructure because of solid yield for those people in that space, because we still see demand in that space, and also some of the emerging potential property trusts. The other thing we've been quite focused on is really intellect or technology. So we've been obviously following things like car sales, REA, what if, etc. And more recently we've been looking at things such as IPP or iCars, which is really a version of, in our case of IPP, REA for Asia, and in the case of iCars, that's similar to sort of car sales. But obviously much smaller and very much an embryonic part of the evolution as such.
It all comes down to understanding, again, well, you never know for sure, but having a fair idea of the long-term cash flows of a business. So resource companies are very, very difficult to get an understanding because the earnings are premised upon commodity prices, which are so unpredictable. So we don't really have much resource exposure at all. We might do if you get the stocks cheaply enough, so your margin of safety is high enough, but at the moment that's not there. So you really have to focus on the industrial sector where you get good idea of long-term earnings, companies with low debt if possible, with sustainable businesses. So the sort of stocks we have been buying, Flight Centre's been one of our good calls recently. It's gone up a little bit, but we really like that business. It's dominant in the travel industry, got very low debt, very low overheads, and it's taking advantage of these airfare wars. We like ASX at the moment because, again, it's trading at a very fair price, but not anticipating any uplift in equity markets, and they have huge leverage to that. Fairfax in the media space we think is a pure value play, as some of the parts play. In the finance space, that's an interesting sector. In the lower area of finance, you have the Orco and Babcock. After they went under, there was a big vacuum in the small to medium enterprise vendor financing market. So FlexiGroup's been a 10-bagger for us in that space since the GFC, but also moving into that sort of space is Thorn Group and Cash Converters. So that's a really a sector type area that we like. We also like Challenger in that space, and in insurance we like QBE. It's had 3 or 4 terrible years, but on any sort of long-term normalised earnings, it's probably 50% undervalued. So you can see the theme coming through. It's all about companies that you get good idea of long-term cash flow, and you're buying them at the right price, which is always the key.
I am nervous in relation to there might be another pullback. What am I looking for? Look, who knows in relation to Europe. Italy could do something crazy, Mr. Berlusconi. The US still has the debt issue to deal with later this month. And in relation to our own country, we've got an election in 7 months, so how that sort of pans out. The first week's been interesting, so we'll see what happens over the next 7 months.
Well, given it's impossible to predict where the share market is going to go, and you do get these global events that shake it in the very, very short term. So I've got no idea where the index is going to be, but I just again look at the value proposition, and to me the value is outstanding at the moment.
Look, I'm reasonably positive, but I think because people actually need an income, people are looking towards that, and if we believe theoretically that the interest rates will continue to fall, then I would suggest that equities should continue moving upward. If you said to me, Alex, where we've been in the year, look, I'd hope 5,200 or thereabouts, but I think it'd be really driven the high yielding space, but also what you're seeing, that cash is moving down to mid and small cap sector, and we're starting to see that.